To the home builders themselves, our next guest says valuations are currently as dislocated as they have been at any point over the past 10 years. And when that happens, they've returned almost 50% relative to the market over the next 12 months. That's a potential profit opportunity. So here to discuss that thesis is John Lovallo, U.S. homebuilders analyst at UBS. John, that's a heck of a tease, because if this really is kind of play out like history, there could be some real money to be made. What exactly is taking you through that part of your analysis, and what do you think is going to happen?
Sure. So to put things into context, since the beginning of earnings season, the builder stocks are up 20% versus the market 3%. So a nice outperformance. And really, we titled our preview note Bear Trap. And what we felt is that, look, investor sentiment had turned way too negative at a point when consumer confidence was starting to stabilize. We started to see interest rates stabilize. And most importantly, we were reaching the end of that negative earnings revision cycle, right? So now you think about that as a backdrop. And then if you think about from a cash flow standpoint, our valuation team at UBS has said exactly what you just indicated, that these stocks are as dislocated as they've been at any point over the past 10 years. And that has resulted in very, very strong returns as we go forward. And we've seen green shoots. Toll Brothers reported that traffic was up 15% in their communities in August. Web traffic was up 5 to 10%. Our consumer intent to buy index was at 37%, well above historical averages. Things are starting to move in the right direction.
Where are those green shoots most evident? Are they going to be in parts of the spectrum a la Toll Brothers on the kind of luxury high-end side of things? Or are they more towards maybe entry-level starter-type homes that gears more towards, say, a Lennar or others out there? Where exactly is the most activity going to be had?
Great question. We still think that the entry-level first time is the hottest spot to be in. That is where there is the least competitive inventory out there. There is some inventory, but it's old. I mean, inventory on average is about 40 to 45 years on average. And the lower priced homes, they're just not out there. And so the builders that can put inventory in the ground at affordable price points are going to be best positioned. And I think we're going to start to see the green shoots there. So far, Toll has been the one who said that that they've seen them. But look, their price points span from $400,000 to $4 million. So they kind of run the gamut.
New home builders, their primary competition may be arguably with each other, right? But they're also with existing homeowners.
100%.
If you have a situation with interest rates falling, hypothetically, in a cutting cycle, what does that do to home builders who are at the same time beneficiaries and, falling under the knife of falling interest rates when it comes to competitive dynamics with existing homes on the market?
Yeah, I think Diana hit the nail on the head, is that it depends what the long end of the curve does. Now, let's assume that the long end comes down with the short end. Now, what that could do is bring more existing home inventory into the market. And to your point, that could be a headwind for the builders. However, what I would tell you is any day of the week, we would take lower rates. It opens the pool up to more buyers, for one, but also Diana mentioned that the interest rate buy downs that the builders are doing, they're expensive. And to the extent that they can reduce those buy downs, that's going to be so accretive to margin at the same time while more buyers are coming in. So I think it's really a win-win.